I've got a massive fear of failure. If you start a rent-to-rent company, it doesn't necessarily help you buy property. If you want things, they cost money and you have to do things to get that money. Do one thing really well, become an expert in that. But you've really got to do things you like to be good at them. As somebody who's full-time in property, I would say starting out outside of your residential, it's maybe not the best asset class to invest in. Buying at the right price can protect you a lot of the time from all of the what-if factors along the way. I like the idea of property because it's like can't go broke fun. When you're doing things that are good, you have to sing about it from the rooftops. COVID hit and went from making £30,000 a month to losing 15,000. I had like a difference of opinion with my co-founders. I invest in businesses, but more often I invest in
I hope you guys are excited to get into this episode. Don't forget, if you would like to purchase an investment property in Dubai, make sure to fill out the form below and book a free consultation with me. Welcome to the Building Wealth with No Borders podcast with me, Lamide Elizabeth, where I'll be bringing you guests from around the world to share their strategies on building wealth. And today we are in London. I'm actually filming at Myriad Studios. So if you guys are looking for a reliable studio to film out, definitely check them out. We are in London with property investor and developer who has completed over 35 projects, co-founded a £1 million rent-to-rent business and has over 5 million in assets under management. Kazeem Alli-Balogun, also known as PropertybyKazy. Welcome.
Thank you. Lovely intro.
Did I get all of that right, or it has some numbers updated?
Yeah. I think that's quite an old bio, but like I think it's fine.
It's fine. Okay, cool.
Yeah.
Okay, so to get started, it will be good if you could just introduce yourself a little bit better. You probably do a better job than I can.
Yeah. So. Again, you got my name right. So I'm Kazeem Alli-Balogun, better known as PropertybyKazy, property investor, developer, and then do, like everyone, a bit of social content, presenting and education around that space. I've been a property developer I bought my first property 13 years ago now.
Oh, really?
So quite a while in the industry, and have done everything from just straightforward refurbs, auction purchases, HMOs, airspace developments, new builds, flat conversions, so residential and commercial. So I've kind of done bits of everything in the property space and have found what I like, what I don't like, and have now kind of sort of carved my own lane within the space.
Okay, that's exciting. And I think one of the reasons why I really wanted to get you on is because you do have that breadth of experience across so many different strategies. So we'll definitely get into that. But before we get started, could you share a bit more about like how you grew up in terms of like money as well?
Like in terms of, like I always remember, and this is probably going to be a showing my age thing, but I think that in terms of money, I remember like the Argos catalog was like, that was quintessentially how I understood money, because it was like, right, this big book of all of these things that you can purchase. And I'd go around with like my felt tip and I'd circle this and I'd circle this, all the stuff that I wanted. And I think at an early age, I thought to myself, if I could just get £500, I'd have everything I ever need. Like, I've got, whether it's the Game Boy, whether it's like, the football that I want, all of these things. And I think that was my first kind of real understanding of, okay, like, things cost money. Like you can't just get what you want whenever you want. And I'd always worked in terms of, paper round really early on.
Really?
Yes, I did. Yeah, we did paper
How
rounds.
old was you when you did that?
My paper round, I would have been.
How do you even sign up for that?
They just have a thing in the window at the newsagent saying looking for a paper boy or girl, and you just apply and you get a trolley and they deliver your papers to you, and then you have to fold them and put the leaflets in them and stuff like that. And I think that was my first. Okay, cool. Like that
was your first job.
First job,
How
technically,
old?
Probably like 12.
What made you want to go? Was it the Argos catalog that drove you to get that job?
Yeah, like it was the idea of, and that's why I always tell the story. It's the idea of understanding if you want things, they cost money, and you have to do things to get that money. We work in a service-based world, so did that, and I think one thing about sort of doing that was I realized this is a lot of work for not necessarily a lot of money. Like, we're talking on a bad week, you might make sort of £12.50. On a good week around Christmas, it might be sort of £25, which is great at that age. Like when you're 12, you make £100 in a month. I'm talking days where you could go to the park on a Saturday of £1, and that's all you need for the entire day. But very early on realized you need to get as much of a return on time as possible. And I think the entrepreneurial side of me was like, how can I get more money? So I remember going down to, it was called, it used to be called Saver Center, which were like the big Sainsbury's. And they had like the machine where you could print your business card. So I printed like a business card, probably age of like 13. It was like leaflet delivery expert. And then I went round to all like the local pizza shops and takeaway places and being like, listen, like I'd do leaflet delivery because I was already doing it.
Was you going by yourself or were your parents helping you?
No, like 13, I was out going by myself, yeah.
Wow.
So it was going there, telling them, this is what we do. It was the we, you're always the royal we in business. And basically it was just a case of, look, if I'm already going out to drop papers to all these houses, if I can go direct to the source, because I'd get an extra £1 for like putting in the leaflets. So I was like, well, I could go there and be like, look, give me £20. So you double what you earn. And I think that really kind of showed me, okay, like if you can think outside the box and not allow what you earn be determined by who you're working for.
Yeah.
I sort of saw that at an early stage.
Were your parents entrepreneurs or did all of this you just came to you?
Very different. My mum is very anti-money. Like my mum, I think, is on the edge of, she's definitely not a capitalist. She works for love. So my mum she actually worked as a social worker in Brixton, in the Brixton Youth Club, and then transitioned to working into schools. Long time ago, she retired now, but did 30 years, probably like on the equivalent of minimum wage, just teaching gardening in schools because that's what she really liked. And she's very sort of almost like, you don't need a lot, you just need to be happy. Mum's English, dad's Nigerian, first sort of generation migrant. So he came and, I saw the transition of, where we first lived, where my dad was a minicab driver whilst having a stall at a market whilst in all sorts of odd jobs and sort of going through university to qualifying as a solicitor.
Oh, wow.
And obviously I saw the transition of, from potentially like not having a lot to being a lot more financially, well off. So I saw the importance of hard work. And I think that there's always this thing like that, coming from, I guess, like first generation migrants, you see it as like, they take it so far in terms of like, I guess like the relay race analogy, and then they pass the baton for you to then go and see what you can do with it next.
Okay, cool. So 12, 13, you've basically already quite entrepreneurial. Yeah. What was you like in school?
I think from like the Nigerian background, very like polite to your elders. So I think my reports were always like, he's nice, he's polite, but doesn't apply himself. Well, kind of like, I guess would be my regular occurrence in terms of school reports. But I was always, I think, fortunately, wasn't fully book smart, but was intelligent. Like, so could get by without having to do a lot.
Did you like school?
Yeah, it was, looking back on it, like I didn't love it. It was just something you had to do. And I think probably if I liked it, I would have done a lot better. And I think I remembered that going forward into business, that you've really got to do things you like to be good at them or to make a success of them. Because when it's hard, if you don't like it, it's so easy to just be like, I can't be bothered with this anymore. So I think all the businesses that I've run and been involved in, they've always been things that I've had a passion for.
Okay, so then take me through to like uni.
Yeah.
Did you go uni, A-levels? What did you do?
Yeah, so I did school. Whilst at school again, first job at like 15, was at Primark, then at Phones For You, where I learned like a lot, kind of particularly in Phones For You. I went to not sixth form, went to a college, did 3 years at college, so sort of messed up a year, did 3 years at college.
What did you study?
In college, I did history, economics, business studies, and law, but dropped law. And again, took a little while, took an extra year. But I think, and same with uni, I went to university, then went to Brunel, 2 years and ended up dropping out of Brunel. And I think both of those things are the importance of, is it what you want to do? Probably at the times, it was like what you're supposed to do.
Yeah.
Like parents are going to say, you've got to go to college, you've got to go to university. But really for me, there wasn't much of a focus. It was just like, I'm here, but there's also nobody now at this point telling you have to turn up. If you don't turn up to uni, nobody cares. Like you're paying. That's your business. Yeah. You waste your own money. And I think that's why, for people that are trying to work out what to do next, you've really got to do what it is that makes you happy and where your focus is.
So when you were working at Car Phone Warehouse or all the other jobs you did, what would you do with the money?
What was I doing with the money?
Did you just stack in?
Not really, you know. Like, I think I just had a relationship with money where I was just like, because I'd always worked, and obviously I guess a lot of my peers that hadn't necessarily, I just had the money to do whatever it is we wanted to do. And I always remember, I don't feel like from the age of like, 15, I've always, if someone wants to go out and get food, I've never said, oh, it's a bit tight this month. Like, will I go to Nando's, go wherever. I always like holidays, so traveled a lot. I think that's probably where a lot of my money went. And I think probably up to the age of about 20, if I go back and look at like the throwback pictures, I remember that I had like my Gucci belts and my whatever, and my Prada shoes. But up until the age of 20, like there's a period, it's like there's a gap in the middle of from like 20 to 30 where I was like, I don't like this stuff anymore, where I was back in, whatever it was, H&M, just basics. And but yeah, probably enjoyed at an early stage.
But then, when you had money that young, did your friends have money? Because it's very, it could be legal or illegal, but it's very different when you have money, and because I don't know if you grew up in a low socioeconomic background, but when you have money and no one else has money, it's not the same.
Yeah, I think like some friends, like again, a mixture of friends. Like some friends have money that probably wasn't, was maybe slightly ill-gotten. Some friends again have money because their parents have money, and then there were those that didn't. But I think one of the good things about my friends group is no one was really that aware. We were just around together and we were just friends. Like, it wasn't kind of friends for the case of, oh, these are the guys with money, these are the guys with or without. They were just my friends that I grew up with, that we were close and we're still close now, like regardless of people's positions.
I love that. So then what changed at 20 with this when you decided you don't want to flex no more?
I think it was was it sort of 20 to 21 was like the year where I dropped out of uni. And you've got to understand that like, up until that point, everything is very predetermined.
Yep.
Like everybody goes to school, everybody goes to sixth form, everybody goes to uni. But then the friends that, maybe weren't up to the best, they were flying in whatever nonsense they were doing. The friends that had dropped out of school at 16 and had gone straight to work, they've now got 5 years of experience. They're rising the ranks. The friends that have gone the more conventional route are just graduating university and are in these grad schemes where they're getting higher salaries. So that was kind of my moment where I was like, I've messed this up. Like, I've wasted like 3 years. I'm really behind. I felt like a failure. And I said, I can't feel like that ever again. So in my head, it was like, look, stop spending money on stuff you don't have to, and actually focus on doing something that's, really going to make you successful and also like enjoyable, because I didn't have the option now to go into a grad scheme. Almost ego told me that I don't just want to start work when I'm going to be 5 years behind and maybe working for, do you know what I mean? Like, working for someone my age is going to be my boss sort of thing. So I think that idea of, and up until this day, like, I've got a massive fear of failure. Like, the idea of like feeling like I've messed this up, I think is what the days that I'm tired, the days that I'm like, don't really want to do the work, I say, nah, I can't feel that way ever again.
Because of how you felt when you dropped out of uni.
Yeah. And not just the not dropping out of uni, but being in a place where I felt like I didn't really have direction and feeling like I was behind. So that point, I think, is when I started like my first kind of proper business, which was the shisha business.
Okay.
So, gone on holiday, sort of seeing this shisha stuff was brand new to me. It was like, oh, this is cool. Found something that I like. And just sort of realized around just generally just going into the shops, you can buy the equipment, the kind of the disposable products for this amount. So I invested probably maybe like £500 into shisha equipment and was like, right, we're going to give this a go. And kind of had our first proof of concepts where a lot of friends did things like promoting events and stuff like that. We'd be like, look, listen, like, let me get into your event. Provides a USP for your, like a unique selling point for your event. You're going to have shisha in like the smoking area. So you don't pay us, we don't pay you. We'll charge the consumer directly. And that sort of first night of being like, okay, you know what, we've gone out there, we've sold like, I don't know, 25 shishas or whatever it is. We've made £500. We've made our money back from the initial investment and we've still got all the products to go again. Was like, okay, this is a business that potentially has legs.
So you went to Egypt with your friends?
Yeah.
So then you guys all saw it and then you put your money together and came back?
No, so this was just, I went with my partner at the time, and yeah, so I went with my partner and I just seen the shisha stuff and it was just me. Like, this was just I was like, okay, I'm going to buy all this shisha stuff. And yeah, like, it wasn't like a grand plan. It was just like, let me just try something and see what sticks.
And then how did that progress?
So it went from doing just sort of like your odd kind of nightclub here or sort of pub pub garden when people had events on, to transitioning into being in some of the biggest like clubs in the UK, like really popular clubs in Mayfair. We was in Proud 2, which was the biggest club in the UK at the time, to then actually starting to do like festivals, so paying for pitches at festivals where, you know, rather than making hundreds of pounds a day, we're making thousands of pounds a day, and actually seeing, okay, you know what, there's some good money, because again, like the margins on at the time on at Shisha was like, you know, we're talking like thousands of % in terms of markup. So it worked,
I guess because
really
it was
well.
so cheap to purchase in Egypt.
Yeah, but just in general, even in the UK, it's like, you know, you're purchasing the actual equipment can be used over and over again, i.e. the shisha pipes, but the flavor, the tobacco, like it's equivalent of maybe £1 worth of flavor you're selling for £20.
Okay.
And the relative consumables of the pipes, the coals, the this, the that, like you're spending £2 to deliver a shisha and you're selling it for 20. Like, so you're at 1,000% markups.
So when did property come into it?
So after doing that, then transitioned to having a fixed location. So a shisha bar that we had that was actually, I went back to university.
Okay.
I went back to South
Why did
Bank.
you go back?
Because I actually wanted to go, and it felt like it was something that I wanted to do. So I always felt like I wanted to go, but it just wasn't the right time, didn't have the motivation. So I went back to university.
So how old was you when
Bank.
you went back to uni?
I would have been probably like a year later, so like 22.
Okay. Did you start from year 1 again?
Yeah.
Okay,
so
cool.
it started from the beginning. So probably didn't graduate until like 24, 25.
Which is still young.
Yeah, but relatively it's not, because in the grand scheme of things, you've been on this earth for 20 years. I'm like almost 25% behind your peers. So it's young, but in terms of the life you've known, you're almost 25% behind. So I went back to uni, actually had like the shisha bar around the corner that did, you know, really well for around sort of like a 12 to 18 month period.
But how did you get the money to get a space?
So actually managed to get something called like a license to trade.
Okay.
So we didn't have to pay rent up front because we didn't have a lease. So with a license to trade, it's much more like an AST. They're like, right, you can operate here. However, the downside of that is at any given time, your landlord can say, well, we want the premises back, which meant, and I guess that is kind of the light bulb moment of transition into property, because we had this great space that was making good money. But again, as an old pub, had loads of issues. The basement used to flood, the toilets used to get blocked. And in an ideal world, the money that we made, we want to invest into the premises. But because it wasn't ours, and at any point in time, our asset effectively could get taken away, we weren't able to invest the money into the premises. So that was kind of my thing of, look, whatever I do next, I need to own. And I guess the natural transition from that is into property.
So when you say a shisha bar, would you selling food? Because I don't do these places. Are not for me. Do you sell food as well?
So we didn't have the necessary like consents, like license to do food.
Okay.
So we did drinks and shisha. So it was we had an alcohol license, and obviously we did the shisha in the smoking area. For food, we actually, funnily enough, it's like, have you ever heard of Lebanese Grill?
Yeah.
So Lebanese Grill used to do our food. So they were around the corner from us. So basically people would just order from us, and then we would get the food from Lebanese Grill at a premium.
Oh, I love that.
Yeah.
Whose idea was all of this stuff?
This is just like, I think it's just like learn by doing. Like, you're like, right, because imagine like we're sitting in this space and we got 20 people and they're all the time saying, we're going to leave now to go and get food. Like the whole idea of being an entrepreneur is problem solving.
Yeah.
You could let people leave, but ideally you want to make money out of each individual customer as much as possible. The more they stay in-house, the more drinks they buy, the more they say, actually, I want to refill on the shisha. So it wasn't just a case of, to start with, it wasn't even, we wanted to make money from Lebanese Grill. It was more a case of, actually, we want to make sure we keep the customers here for as long as possible, so you can bring food, but just the food that we say. Then over time, I always think when you're trying to build relationships with people, loads of people want to go in and would be like, right, we want to get this food from here, but can you give us a discount? But in my mind, I'm always like, let me do proof of concept first. Let me show you that we can bring you an extra 30, 40 orders like on the days that we're open. And off the back of us making you money, now let's work out how we can make it mutually beneficial.
I love that. Okay, so you had this, I guess one of the problems that you had was what kind of led you to property. So what was your first like property investment? What did you do first?
Yeah, so again, I think it was also like lifestyle wise, the idea of sort of being around drunk people a lot of the time and alcohol and the late nights, sort of wanted to move away from that and said, okay, so reinvest the fund that I'd made over that period. And my first property was actually a property that I purchased at auction in Southeast London, so Sydenham, an area that I'm very familiar with.
Mhm.
It was a 1-bedroom flat that was bought from the housing association. And I remember like sort of sitting down with my broker and being like, right, credit's not the best. You're using a bridging loan, you're buying at auction, probably like all the things in hindsight, like without the necessary support, all the things in hindsight you probably shouldn't do on your first purchase. But the vision was there, could see how we could add value to the property. And I think the most important thing was made loads of mistakes along the way, but bought at the right price. And buying at the right price can protect you a lot of the time from all of the what if factors along the way. So ended up buying that property for, I think, around 220,000 pounds, something like that, with a 25% deposit. Did a very budget and ambitious refurb at the time, obviously used.
Wait, but I don't get that. So you bought from auction.
Yeah.
Is it still 25%?
With a bridging loan, yeah.
Okay.
So with a bridging loan at auction, so generally, depends on the lender, it can even be a little bit higher. But if you buy with a bridging loan, firstly, like credit isn't as important. Secondly, because they're lending based on the asset, affordability isn't important. So a lot of the time with bridges, depending on the type of bridge, they don't have a minimum income requirement because it's based on the security within the asset. And because it's a short-term lending facility, it's all about, well, if you buy a property for 200K and you're going to put in a 50K deposit, we know that even if you mess it up, we will sell the property for 160K and get our money back. Also, it's important to note that although they may advertise or offer a 75% loan to value as a gross, their fees, so their interest, their arrangement fees, are generally taken in advance, which means that your net loan is lower. So if your cost of lending is 10% for the year, your actual real net loan may be 65%.
Okay.
But there are now lenders out there who will actually offer now up to 80% net day one. So you can still buy at auction with maybe a 20% deposit.
Why did you go for auction? Like, that's just like one of the most high risk things that you could have done.
Yeah.
Like, who gave you that advice?
I think I'd been around property for a while. Like I'd been around other developers and kind of seen what people were doing. And I think a lot of the time it's just you see what people are doing. It's like, for my sins, you probably just think, oh, that's what I'm going to do as well then. But ultimately, what made me go for that was the property made sense. Like it was an area that I knew the values, I knew what it would be worth as a two-bed, I knew what it would be worth refurbished to a high standard. And I could see the margins and see that it still represented a good return on investment.
Did you do it alone?
Pardon?
Did you do it alone?
Yeah.
Okay. So sorry, I think I interrupted you. So what were the numbers? Like, how did it work out?
So purchase price was around 210,000, which means at 75%, you're probably looking at with the retain. So 210,000. So you're probably looking at around like a £55,000 deposit, but then your interest would have been retained. So the interest on that is probably around, to include their fees, round it up to 20,000. So you're at sort of £75,000 plus, and there's a much smaller stamp duty contribution at that point as well. And I probably had around £90,000, and my refurb budget was supposed to be 25. So I knew I didn't actually have the money to kind of finish. But I knew I had the money to get the property. So purchase, for 210, say fees of around 20 odd fees, refurb budget of 25, which means we're all in for about 260, something around that with legals and some other professional fees. And ended up selling the property for 310,000. I'd say the refurb costed a little bit more. My finance costs were a little bit more, but probably made profits of around £30,000 from, an investment of circa 100,000.
So where did you get the money from if you didn't have the money up front? Was you keeping the shisha business going?
So I had the money from the shisha business that had then closed. I was still, at that point, was I working? I think so. I had the money for the deposit, the money for the works, or for part of the works, and then at that point in time, I think the rest of the money, I kind of there was a few friends that I said, listen, just lend me the extra 10,000. I need to finish the refurb, and I'm going to give you 12,000 back in X period of time. So they made a return of maybe sort of 1,000 or 2,000. And obviously now that's investor finance. At the time, it was just listen, mate, I need a loan.
Okay, Okay, cool. Do you, okay, so how did you feel after you completed that one? Was you like, yeah, I'm the guy, I can do this now? Or?
I think like afterwards, no, like, because very much like I was just like, what's next? So I didn't really have that moment of, oh, I've done this and this is amazing. It was like, okay, cool, I've done it, but I don't have a fully fledged business, a job, anything else. So I was like, I just need to go and do the next one. I don't really think I got to stop and sort of smell the roses. And also during the process, there's mistakes that were made. So I didn't really feel like, oh, I'm doing anything amazing. I was just like, okay, what's next?
That's fair. So what did you come up with? Like, what was next?
Just rinse and repeat. So again, I think actually ironically was another property in Sydenham, same sort of area, and just did the same thing again and did that a few more times, started doing sometimes even like maybe multiple a year for sort of the foreseeable future after that. And I think it's volume. Like the more you do, the more opportunities you have to quote unquote get lucky. Because I'm doing these deals on the basis of, okay, like if I can make a 25 to 30% return, it's good money. But then did some over time that, we were hoping to sell, or I was hoping to sell for maybe 300,000. They ended up selling for 360,000. So now your return rather than 30,000 is 90,000. And then your working capital is increasing to enable you to actually go and buy bigger properties that have, more better returns or just higher returns.
Did you have a goal that you was working towards?
Nah, never. Like very much so at the beginning, it was like, look, it was just a case of I wanted to do stuff that I enjoyed. I wasn't where I see like a lot of the people that start in property now and the people that I work alongside, like they're amazingly like laser focused in right, I want to get to this many million GDV, or I want a portfolio that cash flow is X. Whereas I enjoyed what I was doing. And I think that was almost enough. Like the fact that it made money was like a bonus. But like I just generally like, okay, this is something that allows me to live the lifestyle that I want. Because at that point in time as well, like I might do a project that's busy for like 2 or 3 months. And after that, I can kind of chill. So whether I want to play football, tennis, badminton, go on holiday, had a lot more flexibility. So it kind of fed into the life balance that I wanted to lead, rather than just I want to be this big time property developer.
Okay. But so you are now though. So when did things change? When did you start to get like, or are you like, are you now a lot more like regimented about, okay, this is the goal, this is what I want to do? Has competition? Because you seem like, it seems from what you have said, like how other people around you, where they are at also affects how you kind of felt about where you were at. So did that kind of put like fire up your bum or anything like that?
Nice. I think like I've always had this like, I guess because I've not so much gone without, in that I've always been in a position to make money. That idea of like, okay, I can't be a failure was important. But from a monetary perspective, I've not looked at it that like, I need this much money, because I think particularly at sort of 20, when I stopped spending money on stupid things at the time, like it's like you realize that you don't need that much to kind of be happy. So my focus wasn't really like money led. And if at a point in time I felt like there was something that I wanted to do that I couldn't, then I'd be like, I need to go and, all right, what's next? I need to go and find a few more good deals. I need to find some opportunities. But if I'm honest, like I've not been the 5 a.m. club, wake up, journal, all of these things. And I'm sure that they're amazing. They work for people, but that's never really been me. It's just been a case of, look, I'm going to do stuff that I enjoy. The great thing is that there's a byproduct that it is quite financially rewarding. But there's been loads of properties that, if you ask me honestly, like how much did I make this year or that year, or I wouldn't even know.
Really?
Yeah.
Interesting. Because I think the way you're kind of speaking, you're speaking very humbly in terms of just like, I think if someone was just listening and they'd never come across you before, they wouldn't actually know the extent to which how much you have done. So can you share a bit more about like, if you were to like, if I said, okay, just brag about how much you have actually done. Can you share some of those numbers so we can actually get a grasp of actually done quite a bit? Yeah,
like we do like projects that make like really good returns. So like flat conversions, for example, buying units for £450,000, spending around 250 to 280,000 pounds on the refurbs, and they would then sell each individual unit for over 300,000. So we're looking sort of 1.2 million. We're looking at profits of maybe £500,000 from each of those within a year, which is great. But like, one of the things is like the sign of a good property developer is a broke property developer to a degree, because in answer to kind of to circle back to one of your questions is Like, should somebody leave £40,000 in an account? Definitely not. Should a property developer leave £500,000, £1 million, whatever the case may be, in an account? No, because it's a business model where you make money from having your money at work. And the second that money is just sort of sitting in your account, you're not getting a good return on it, because what are rates at the moment? Even if you get a great savings account at the moment, you're looking at sort of 4% if you're lucky. Whereas if you can actively go and make anywhere from sort of 30 to 50% return on your money, then it's basically dead money if it's sitting in your account, I guess.
In terms of like gross transaction value, how much would you say you've done? If you're enjoying this content, please don't forget to hit the like button and subscribe. And if you would like to become an international property investor in Dubai or in the UK, the link to book a free consultation will be in the description box below. If you're not quite ready to invest yet, check out the affordable video courses that will also be linked in the description box below. And if you would like to relocate to Dubai, set up your business in Dubai, or anything else related to relocating to Dubai, check out www.theprofessionalnetwork.com.
That's a good question. GDV wise, in the 8 figures, but I don't know where that sits exactly. Okay. Like lower mid 8 figures, like personally. But then I've done a lot of JVs as well with other people been involved in. So I guess it depends where we sort of draw the line at my stuff versus joint venture stuff as well.
Fairs. And then how many projects would you say you've completed?
So I think on my bio it says 35. It's probably about 50.
In over the last 13 years?
Yeah. Have I done more? Yeah, probably around 50 projects, like, individually. And then I've worked on a lot of other projects as a JV partner, or a lot of the stuff now as well, more from, I bring my expertise to be involved and get paid off the back of that. So people bring the funds, whereas I'll deliver the actual project. But a lot of the time we'll operate in other people's, I guess, JV and other people's companies, or would operate as an SPV as well.
What are your thoughts on property and like building wealth? Because you're a property entrepreneur, right? I don't know if in terms of like an asset class for investing, if property is something that you hold as well, or if you just use it to make money. What are your thoughts on that? Yeah,
so definitely. I mean, I do hold a portfolio, and I try and have a very fluid mentality when it comes to, flipping properties. I always base on whether I'm going to keep a property on just what does the market determine, because you've got to avoid those over, emotional attachments with, I just want to hold this house because that sounds good. Some properties don't necessarily make sense to hold because they don't represent a good return on investment. Quite probably sort of hot take is, as somebody who's full-time in property, I would say starting out, it's probably outside of like, maybe your residential, it's maybe not the best asset class to invest in. When you look at loads of the people that, whether you look at like the Richard Bransons, the Alan Sugars, that you see that they hold really high amounts of assets in property. But what you'll find is they generally invest in themselves, invest in businesses first, and then their property portfolios, the diversification is actually lower risk, lower reward, but it gives them stability to take more risks in other areas of their lives.
So what would you say is like a better thing to investing?
I mean, so
because I'll let you answer first.
So for me, look, I'm quite risk adverse. Like, I like the idea of property because it's like I can touch it. It's like my I can't go broke fund. It pays me a certain amount of money on a monthly basis. I know that if I was started from having very little money, that, having a decent sized property portfolio, if something else goes wrong, you can start again and go again. Outside of property, probably my main thing is like angel investing. So I invest in businesses, but more often I invest in people that run the businesses. Because if somebody's got an idea around something, it could be a restaurant, it could be, it could be something to do with tech. I don't really understand the business. I might understand the opportunity, but I need to understand the person is going to be in a position to deliver it. So from a diversification standpoint, I guess I do angel investing in startup businesses.
That's quite high risk, but that's equity as well.
But also like because of what's it called now?
SEIS?
Because of SEIS, it can make sense from a tax perspective, because if you can write off up to 50% of the investment against tax, and then also if the business fails, you can write off a further 50%. Your exposure is actually only 25%. And obviously, naturally, startups are going to fail. Like a large percentage of them do fail. But the ones that don't fly so it's that balance. And I think that's why diversification, whether it's through quantity, so in property, I diversify through, rather than doing one big project a year, I might say I do 5 or 6 smaller ones. So if one doesn't necessarily go exactly to plan, the other 5 can help to prop it up.
I love that you've said that because, well, one, angel investing is something that I'm quite big on now as well. But I think with property, there's kind of 2 sides of it. There's the side of using it like, I'm not a property entrepreneur at all. For me, it's just when I think about investing in property, it's just the first asset class that I wanted to build because I wanted to be able to quit my job. And I needed something that I knew that I could, what did you call it? Something?
I can't go broke fund.
That, exactly. Yeah. I needed that. I needed the passive income. I'm not like necessarily trying to do all these flips and stuff. It's not my business. I just like having that security of it there. But I would agree that like, it doesn't need to take up your entire portfolio. And I think a lot of people do because it's the easiest. It's the one asset class I think we talk about a lot.
It's just the most understandable. Everybody needs a house. So you know that growing up, you needed a house. Generally speaking, our first exposure to wealth, whether it's us or the uncle or the auntie that had the nice house, that's what we understand intrinsically of the idea of wealth and security. So it's really ingrained like economic into our heads that actually property defines stability or defines comfort. So I think that's why a lot of people, really like it. But when I speak to people, and some people that are amazing entrepreneurs and business people, and they're like, oh, I want to, get into property. And I'm kind of do a bit more of a deep dive into their journey. I'm like, your business is cold. Like you should be investing into that. Like, of course, if you've got spare money, I'm the person that would say put it into property over crypto, depending on your attitude towards risk. But, I think at an earlier standpoint, like building a cash flowing business is probably going to be more beneficial in the long term.
I love that has come from you because you're so big in property. But in terms of property, if people are like, okay, if someone wants to get into property today, let's say they're like 30 or something and they've got some cash and they wanted to get into property today, and the aim is where they're going to get the best return for their money, they don't necessarily have the most amount of time, what strategies would you be recommending?
I mean, look, so obviously HMOs are great because they cash flow really well. Like you can invest in areas that maybe don't typically have the best yield, but you maximize it by working the asset. Because you buy a 3-bedroom house in Croydon for £400,000, for argument's sake. As just a house, it could rent out for maybe £1,500. If you're renting each individual room for £600 and it's got a reception room and a living room, now that's £3,000 a month. So obviously your yield with that increased rental is going to be a lot higher. Also, you could potentially, if like Croydon, for example, something called like an Article 4 area, which means you need full planning permission to, convert a house from C3 to C4 to make it a HMO. You could potentially get a commercial valuation, which means you get a valuation based on it being a commercial asset that brings in a certain amount of cash flow. And the upside to that is that should be higher than your bricks and mortar valuation. So therefore, you can refinance potentially, get more money out, and potentially go again. It still yield quite well. But again, it depends on time, because the person that's doing that now, you've got 6 tenants or 5 tenants to manage rather than the one. People don't get along at the best of times. So 5 people living under one roof. So it may make more sense to have just a standard buy-to-let model, but obviously your returns are going to be lower. So it is very much going to be a case of what are your own, risk tolerances? How much time do you have to manage the asset? Because some of the most straightforward asset classes to manage in terms of property are commercial. Because commercial units, basically, you have to do nothing. The roof leaks, it's the tenant's problem. Like they pay their percentage. You arrange it, but none of that comes out of your pocket. The boiler breaks down. There's whatever it is in the property. So it does make it a lot more passive. But then the lending on commercial properties is often less favorable. You're probably looking sort of 50 to 65% loan to value. You'd have to put more money in, so your yield is going to drop.
Do you have any commercial properties?
2. So one was a commercial to residential. I converted the upstairs into 2 flats and retained the ground floor as a commercial property. And the other one actually was just a great opportunity that came up off the back of somebody who purchased it at auction, couldn't end up completing, sold it for a good price. And it's probably one of my best performing assets.
You kept it?
Yeah.
Okay. What do you think about rent to rent?
I think it's good.
Okay.
So look, I built a rent to rent company. I did it for years after actually starting property development, because I realized actually, again, I'm making these chunks of money, but are not seeing the regular income to provide sort of life stability. I think rent to rent is, it's a good way of making money. I don't necessarily think it's a gateway into property development that a lot of people think it is, because...
What do you mean by that?
Because like, if you start a rent to rent company, it doesn't necessarily help you buy property, because the money up front, like, so say they take on a rent to rent property, may cost £5,000. Now, people are building these rent to rent businesses because they see financial freedom, cash flow, get to cash flow, an X amount of money. But you spend £5,000 to take on this property, and say the property is making you, just for round numbers sake, £500 a month profit. That means that you get your money back in 10 months time. So then in 10 months time, if that's all the money you have, you can now take on another property, which you're now making £1,000 a month.
Yeah.
So then technically in 5 months time, you can now take on another property. But you're building your cash flow, but really your actual capital pot doesn't increase, because for you to grow the business, you're constantly having to reinvest into your rent to rent portfolio.
Right.
And then you reach a point where it's like, okay, at a certain point, now maybe you're cash flowing, I don't know, after like a few years, you're cash flowing £2,000, £3,000, £4,000, £5,000 a month. But really, the skill set that you've learned in terms of, I guess, managing these properties doesn't necessarily help you in terms of property investment and spotting opportunities as somewhere that's good to buy. There are like some transferable skill sets, but I'd say it's a business in property, but a lot of the transitional skills are not as closely related as people would think.
Okay. So who would you recommend it for? People who have low capital to start with?
Yeah, people that have low capital that just want to basically either replace or bolster their income. There are some good things, but I think strategy-wise, like maybe like deal sourcing as like a lower barrier to entry strategy in the property sphere is potentially more transitional, because deal sourcing means that you're operating, basically the type of deals you're sourcing are the type of deals you probably want to source for yourself going forward. So you start to build the skill set of how do you identify a good opportunity? How do you cost like the refurb numbers to get it right? Because you've got to get it right for people to buy it. And then because you're getting your money like in these lump sums of maybe £5,000, the better you get at it, the quicker you can build that working capital pot. Also, if you find a really good opportunity, you can skip the whole phase of, you know, maybe having to actually have the capital, because if somebody tomorrow presented me with an amazing opportunity, but they said, look, I'm not selling it, the only opportunity is to JV with me, I probably would take them up on it if the deal was right. And then you're building a relationship of property investors, of landowners, of potential investors into your own business as well.
I think I don't have the best perception of rent to rent, because when I was looking into it, that it was this group chat where they would just send like different like rent to rent opportunities. Numbers never made sense. Never ever made sense.
Generally speaking, like look at it, because the barriers to entry are low, you need £5,000 or sometimes less.
Yeah.
If it made sense, why would that person not do it themselves? Generally around the deal sourcing for rent to rent properties.
Right.
So I think it does make sense. And look, so the first business, still not the business, the rent to rent business that we built got to like, I think 50 odd properties, probably circa 300 odd rooms under management, doing sort of 7 figures a year in terms of repeating revenue from the business.
How much profit per month would you say?
Around, at its peak, probably sort of £30,000 profit a month. But then COVID hit and went from like, you know, probably making £30,000 a month to maybe losing 15,000.
Ooh.
Like, because you went from having occupancy rates of 97 odd % to 70%.
But then you have your fixed cost that you have to pay to.
You have to pay.
Oh, wait, sorry. Can you explain rent to rent?
Yeah, so sorry. Rent to rent, sometimes described as like property arbitrage, is effectively, for the most simplistic way, you rent a property from a landlord. So you see landlord A, he's got a property listed for £1,500 a month. You say, look, I want to rent this property from you. And you may do rent to rent in the Airbnb space, which is, short lets. You may do it in the HMO space, so house of multiple occupancy, so for sharers. Or you could do it for some of the more government-backed schemes like social housing for, it could be for young, vulnerable adults, people in halfway houses where the government is going to pay a premium for that housing. But effectively, you rent a property, you effectively become the guaranteed rent provider for the landlord. So you guarantee their rent, whether the property is full, empty, good condition, bad condition. And you then get the rent from your tenant type, which may be Airbnb, maybe, like I said, individual rooms, or maybe social housing. And it's about there being a margin between the two. And obviously you provide a service to the landlord as giving them the security of a guaranteed rent, and you provide the service to your tenant type. In my instance, it was the HMO tenants of, really nice, high-end rooms that they could rent.
Thank you. Okay, so go back. So COVID hit and then you're making negative 15K a month. Yeah. So what did you do?
So I think, again, it's like I mentioned that business had sort of co-founders and a lot of stuff you learn over time. At the time, I was very much sort of like, right, well, we just sacrifice all our salaries. We have to kind of like, pay the landlords regardless, get it working, try and obviously speak to, like sort of lenders, look at what we can do to obviously bridge the gap. Now, for me, obviously had like a difference of opinion with my co-founders. And obviously in hindsight, like I kind of completely understand it. They, had young families, they had bills to pay. They couldn't just say, I'm just not going to take the money. Whereas I was in a fortunate position where I had, the development side of things, I guess a little bit more buoyant. And I think I got to a point where I was like, listen, like I don't feel comfortable like having to go to the landlords and saying, look, we're going to pay a reduced rent for a period of time or whatever. So at that point in time, I basically stepped away and was bought out of the business by the co-founders. Now, again, it's like, there's a lot of hindsight stuff. There's probably a lot of things that I could have done better in terms of my interactions. And maybe even one thing that I really took away from that business is when you're doing things that are good, you have to sing about it from the rooftops, because if you don't, nobody will care when things are bad. So, we had landlords that we've been working with for 5 years, had looked after their properties, done all of their repairs, done everything. The properties were in a way better condition than when we got them. Every time something broke down, we just fixed it. We didn't tell them. We would just paid them the rent every month on a monthly basis. So in their head, if the first conversation they had with us is, after like 4 years is, oh, actually like COVID's hit and we're struggling, it was just
you haven't
quite
built in
negative.
Equity, yeah.
Exactly. We hadn't kind of built in exactly that, our goodwill equity almost. So I think going forward, like now in businesses, I'm like, listen, if you're doing something that's good, let your client, let your customer know every day that, listen, I'm looking after you, by the way. So when it goes the other way, they give you a little bit more grace. I think one of the hindsight things was like, sometimes you have to ride out the bad times, because those rooms that, say, for example, we were renting for £600, if we would have sustained and I would have stayed in the business, a lot of those rooms 12 months on were renting for £900. So those same properties were maybe making £700 a month. If you imagine the rental income now per room has gone up to £300, that means every property, the properties are making £700 and now making £1,500, £1,700 if we would have retained them. So that whole down period of potentially, over a 6-month period, maybe losing 90,000, you probably could have reclaimed that, in maybe another 6 months and then been in a much better position. So I think a kind of takeaway for business owners are, you have to look at where things are. And sometimes it's really good to fail fast and just to be like, right, this isn't working. Let me not just try and like keep, I guess the phrase is like flogging a dead horse. And sometimes you've just got to be able to ride the waves of a market knowing that it is going to bounce back.
Ooh, that's hard. Because I don't know. I think any normal person, if you saw something was losing 15K a month. But why did you not want to offer the landlords like a reduced rate?
I think, and again, probably like learning curves, like, I don't think ego is the right thing, but because I guess my role within the business, a lot of it was client acquisition. I'd taken on a lot of the landlords, and I think I probably over-personalized the business. Like I felt like I'm personally letting these people down that have entrusted in me with like their sort of primary asset. And I guess the hindsight would be, look, everybody was struggling. Sometimes, 70% of something is better than 100% of nothing. But I think again at a time, like sometimes with co-founders, just difference of opinions, and you reach an impasse where you say, you know what, actually, despite the fact that, you know, maybe this could be saved, X over here is actually going really well for me. And maybe if I laser focus into the development side of things, my time is going to be better spent over there.
Because I was going to ask, would you like rebuild a rent-to-rent portfolio again?
It's something I've been having conversations with one of the team, and like, you know, we get presented a lot of opportunities. One of the things about having a really good social media platform is it's free marketing. People come to me and they're like, oh, I heard you do rent to rent. I've just finished a development of 17 units. Do you want to take them on? But it's sort of right time and place. I wouldn't do it as like an accidental investment through somebody just turning up and saying, do you want this opportunity? I think it's just market. Like there's always a lot of people look at stuff like rent to rent and be like, oh, it's oversaturated at the moment. But people look at every market and say that, like, you know, whether it's the property investment market, whether it's hair salons, barbers, like, you know, restaurants, there's always going to be an argument for oversaturation, but there's always an argument for a USP. And if you can find a way to do it better than other businesses, there's always scope to get into it. You know, people that are operating right now in the care space, you know, are doing amazingly well. Yeah. They're absolutely smashing it, and that's still rent to rent. But that's not my area of expertise. That being said, if somebody approached me and saying, look, I know all the deliveries, I know all of the Ofsted regulations, I've got all of the staff, but what I'm lacking on is the property side of things. I think potentially the only way I would do it is if what I'm bringing is the property element of the expertise. So the actual being able to acquire properties or manage refurbs, etc. But they're bringing into the actual day-to-day running of the business side of things.
Are there any trends that you see in the UK property market at the moment that you would say, if someone's watching this and they're interested in property, you would be like, yeah, this is a trend that you should be capitalizing off?
I'd say it's difficult for well, I don't know who watches this, but obviously a lot of the trends at the moment are in build to rent accommodation. So if you see like, you know, the big home builders, a lot of them, that's their focus now. You'll see them building new, you know, apartment blocks of 100 units and none of them are for sale. You see like John Lewis, despite John Lewis sort of going into liquidation, they're still investing, you know, hundreds of millions into build to rent accommodation schemes as well. So for people that want to get into larger scale development, I think that's definitely, you know, a good way to go, because people are kind of seeing over time that generationally, the idea of owning isn't as important to everybody else, particularly like, you know, around the London space. So people are really focusing on, like, if I can build properties and mini communities that really provide, you know, an excellent lifestyle. So you're seeing properties now with paddle courts and cinema rooms and gyms and all of these things, because we are very much, I guess, in an Uber society, where it's like, if I can rent a car, you know, by the hour or by the minute, rather than having to own it. A lot of, I think, you know, Gen Zs and people moving in that direction are kind of sort of almost saying, look, I may not ever own a home and I'm kind of okay with that. So I think the build to rent model is working quite well. And whilst people are bashing the buy to lets and saying, oh, it's really suffering in the market, I think it's because they're probably not delivering in the right way.
What do you think about the UK property market in general?
In terms of where it's going to go?
Where it's going to go if someone was weighing up investing. Because I get a lot of people who are kind of weighing up investing here versus investing abroad or investing in Dubai, stuff like that.
So I think, that's one of the most common questions I get asked as well, which is like the UK versus Dubai. The UK, I guess, is you know, naturally a much more established market. So our price points are very determined. Like if we use London as an example, you know zone 1 is uber expensive. And, you know, if you can't afford zone 1, you go to zone 2 and you gravitate outwards based on sort of budget. So it's very kind of a lot easier to just invest without too much knowledge of the property market, as opposed to Dubai, which is, you know, a much newer, not economy, I guess.
It is like 30 years old.
So, you know, they're constantly, you know, in the UK, one thing we say is we're not making new land. In Dubai, they literally are. So there's areas that pop up, areas that were supposed to be amazing 15 years ago, like Discovery Gardens, and not great now and are not seen as like, you know, high value areas. Like, And I think the thing with Dubai is you have to have really good knowledge on the ground to know that actually where the infrastructure is going to be, what's happening, what's changed in next, because it is constantly moving. You know, it's not a case of this is the good area and all areas around this are going to be amazing.
Mm-hmm.
You need to have more of that local knowledge, local expertise, but also from a risk perspective, like, you know, Dubai has had 3/4 kind of full-on market corrections over the last 25 years. So prices have fluctuated, and for the good and the bad. Some of those fluctuations means that people's property prices have effectively doubled in a short space of time. Some of it means sometimes people have lost 50% of the value of their property. So in terms of where people should invest, I think, in an ideal world, you diversify and have property in both. Short term, I think because of my attitude towards risk, I'd always invest in London first.
London in particular, not UK.
I mean, it's because what I know. And
Okay.
I think the importance of knowledge means that you can use that as a way to almost isolate and influence the market. So because I know London very well, I know the difference between the good road and the bad road, the road that's in the catchment area for the right school, the ones that have the south-facing gardens, all of these things that, if you're just looking at it from, where should I invest? And somebody just shows you your property online as a PDF, it can look very good. But then, you see these sort of horror stories of people that have invested somewhere, and it might be somewhere in Liverpool where they're like, I invest in this HMO, it's going to get you £500 a room. And then you Google Maps it, and the properties either side are fire damaged, half the street is vacant and boarded up. And so local knowledge and expertise are what allows you to make good financial decisions. It's like the same people that invest in stocks and shares. I can top level. Someone can be like, I'm going to invest in Amazon because that's what I know. But it's right time and place. And actually, what is the CEO doing at the moment? What does all of these others factors that are going to impact how actually successful your investment are going to be?
I typically would say, well, my opinion would be, but when people ask me between London and the UK, I would say if you don't have that much money, I'd actually stick to the UK more generally, because you can't compare the UK versus Dubai, because it's a city versus London, and London versus Dubai, you can probably make that comparison. But in general, people are talking about the UK versus Dubai. And I think if you don't have that much money, when I say don't have that much money, I mean sub 50K.
Yeah, because you could go and invest in Sharjah, which is if you're doing country to country, you're doing UAE versus the UK, and that would be very, very different.
It's very different. But even still then, I still think you need a lot more money than you would to invest in the UK, because the UK it's not that big, but you can go far and get prices. You can buy a property in the UK for 70K. You
can buy a property in the UAE for 70K.
No, you can't.
In the UAE,
you cannot buy a good investment in the UAE for 70K in a good area.
I didn't say, but it's good areas relative. Some people don't see Scunthorpe as a good area. Scunthorpe in the UK.
Is that?
It's an area. I just wanted to pick somewhere that hopefully no one's from there. But for example, you know what I mean? There's loads of areas in the UK that you can invest in cheaply. There's areas in the UAE, not Dubai, that you can invest in.
You can get in cheaper, but because of the risk, and it's also, I'm talking also from a risk perspective, because a lot of people, right, so let's say you have 50K, it would have taken you maybe 3 years to get that 50K. I wouldn't go and put that as my first investment, go for an international investment in where you're not that sure and where things might change.
If you were Dubai-based, if you're Dubai-based, if you're going to invest in Deira, for example, Deira, you can get property very cheap.
If you want to be in Deira.
But it's the set. But for example, the idea of if you want to be in Deira, to me, is the same concept as again, if I don't know the area, but if you wanted to invest somewhere in, for example, Barnsley, it's not somewhere that I would move to. There's nothing wrong with it. There's a thriving community there of people that love and really enjoy their home and their work there.
Yeah. If I don't have that much money, I'd stay where it's a bit more comfortable and I can have a bit more guarantee.
Because the thing with obviously Dubai is because it's also so new, and they're attracting so much is foreign direct investment, and through people bringing their money to the country because it makes sense. It's very much a case of what changes. So for however long there was no income tax or no VAT, 5%, and it's if tomorrow, for example, not they would, but tomorrow something changes and it goes to 10%. Now, for example, Belize starts to look a lot more attractive, or wherever else. And I think because they're very reliant on the money coming into the country, with everything that's happening geopolitically around the world, you do see those big sort of price shocks. Then couple that with the fact there are so many new areas. There's areas that absolutely flew, that like around sort of City Walk and
oh my God, so many
that weren't necessarily touted to do that well. And like I had a friend that we always joke that our other friend stole his money because he bought a property in Nikki Beach, like really nice 4-bed, probably around 10 million dirhams, so equivalent about £2 million, sort of pre-COVID. And then sort of COVID came and he thought, I think just before prices were looking like they were going to go down a little bit. And I think he ended up selling it for just under what he paid for it.
Before COVID.
Before COVID, sold it. So for example, bought for 10 million, probably sold for just under but call it around 10 million.
Yeah.
Fast forward to middle of 2020. No, same year, 2020.
Really?
Same year, fast forward, I think it was either middle of 2020 or beginning 2021, but we're talking like 12 months maximum between the periods. And he sold it to a friend of ours. She then sold it on for like 14 million.
Yeah.
So we joke that like she stole his 4 million. But that was a price swing that nobody would have expected.
100%.
Particularly based on what was going on in the world. And 100%, like that are amazing.
100%. And I'm very, very, very bullish on the Dubai market in general.
Where are some of your kind of like go-to areas in Dubai?
Dubai? I think it depends. So if they've got money and because I have some clients who are just like very bougie, I just want to be in the best place, whatever, still good appreciation. Business Bay has a couple of good projects that are coming. Yeah. If they are like in it for the long term, where the new airport is coming, so Dubai South, it will always depend on the investor though, because some people kind of like, JVC, some people, you either hate it or you love it. I was just about to that's so funny. My next question was, what's your opinion on JVC? JVC is either you hate it or you love it. I think it has performed really well. It's like top 3 in terms of performance. Yeah. But I don't know. If you want to be like a super early investor, then you wouldn't. Some people are like, nah, it's already had a lot of the capital appreciation already. But I still think because there's a lot of handovers coming in. But
that's the thing. There's a lot of handovers.
What, are you scared about traffic?
No, not so much traffic, but the volume of properties coming to the market in JVC. I think there's like a 30% increase of properties coming.
Yeah, 2026, 2027, there's a lot of handovers. So
it's like, obviously at the moment, it's amazing from an Airbnb market.
But the thing is though, it's because it's cheaper, the demand is there.
Yeah.
Because like when I used to work in DIFC, everyone who couldn't afford to live in Business Bay or just didn't want to pay Business Bay prices, it was like JVC is the one.
Yeah, and it is. And I think, but one of the downsides, this is just turned to our JVC program, but it's just funny. One of the downsides of JVC is because it's so many small individual developers. There's
ugly.
Nobody doing the infrastructure on the roads around it. Like JVC is the sandpit.
Yeah, because it's not like what's the word for it when the developer has the whole community? Like, have you seen? I love
like Creek Harbour. Creek Harbour feels like a simulation.
Gorgeous, so beautiful. But we're going off topic now.
Sorry.
Okay, cool. So I think the final question is, what's next for you before you move on to the final section? Yeah.
So I mean, at the moment, I've really enjoyed. 2 years ago, we set up the PBK community. Because it's like, if you have a good reach, people are constantly asking you, can you mentor me? Can I shadow you? And you've only got so many hours in a day and there's only so many people you can help. So we kind of work with around anywhere between 50 to 100 aspiring property developers or people that just feel like they need a bit more of a helping hand to take those next steps with confidence. And that's gone really well. I mean, over the last, I think it's like sort of 18 months, collectively of a group have sort of delivered £50 million worth of projects. Wow. And we've seen like some amazing success stories of people that have never bought a home to now they're on to their 3rd, 4th project. They've gone from, sort of being like, I don't know if this is going to work for me, to making, multiple 6 figures a year, which is good. And I think I don't want to create some massive like mentoring or education company, but I just want to continue fostering that and using our buying power to like negotiate with banks for preferential rates, start doing, more projects, working with more people, potentially like doing more sort of collective community projects within that as well. Definitely, like, do you remember my intro? Like my intro was like, I've done this, and all these things. I've done loads of different types of things in the property space, but I think really now kind of starting to actually focus on, look, I've got a sweet spot of like a type of project that I do, and it's not big projects. It's really, small projects in good areas like, Fulham, Chelsea, Clapham, etc. So my target, I think is to kind of get to a point where we're buying at least a property every month, and do that continuously, continue to build out the team. So to make it more of a business where I'm working like sort of top level rather than on individual projects. But yeah, I'm just generally just doing what I enjoy at the moment and trying to just continue to find things that I like to do.
Are you content? Are you happy with where you are in life?
Like there is this like, weird like wealth curve stuff where that whole idea of the Argos catalog side, and for the Gen Zs, I don't know how to explain this to you.
No, I'm Gen Z and I did do a little bit of Argos catalog.
Just a little bit.
No,
you was on the cusp. But basically, again, for those guys, it's like, imagine just a big book of everything that you could buy on Amazon, kind of, I guess is like the closest way to kind of explain it. But like, say you start out and you start with a gym membership. It's all, do I want to pay £20 for a gym? So you start with, no, I can just run in the park. You make some money, you say, okay, I'm going to get a pure gym membership. You make a little bit more money and you say, I might get, a Fitness First or a Virgin Active. And it's like, all of the stuff that I want to do, like within reason, like the expenditure increases quite drastically. So like to go from the £20 a month to like now, I think I pay £400 a month for my gym.
What gym are you going to?
Chelsea Harbour.
£400? What are they giving you?
I just like it's got
giving you breakfast?
No, you don't even get discount. I used to get, but the thing is, like, it's got indoor paddle courts, and I enjoy playing paddle.
Okay,
so I'd pay the money for my enjoyment, and that's what I want. But I guess in terms of the reason I said that was like from a contentment standpoint of, because there's not really anything that I want to buy that I can't necessarily buy. I don't have like, oh, I've got to do this or I've got to do that, like, to be able to go out there and get it. And there's loads of things like it sounds weird, but you don't have to have loads of money to, like, you could drive, like, if you want to drive a Urus, realistically, you could spend £2,000 a month on finance and put down £20,000. You haven't got to make a ridiculous amount of money to do it. It's just, is it comfortable? And I think that a lot of stuff is just from what I want. I think I am relatively, content in that I can do the stuff that I enjoy doing.
That's good. So then what keeps you going is just the fact that you actually enjoy what you're doing.
Yeah, I enjoy it. Like, I have all of these like little moments. Like, I was sitting in the gym the other day and like this lady came up to me. She's like, auntie. She was like, hey, I saw you on my TV. And I was like, oh, nice. I was like, I don't think it's me. I don't do TV. She's like, see. She's
talking about YouTube, innit?
Yeah, she's like, YouTube. Yeah. She's like, I was like, YouTube. I was like, yeah, I do the YouTube. Yeah. And she was like, yeah. I was just like, I was like, my son's always watching you. I was like, oh, that's nice.
Aww.
She was like, I was like, I can't remember. I think I just made a joke. I was like, oh, sorry to be on your TV. She's like, no. She's like, because of you, like, him and his girlfriend just bought their first property. Like, they watch you all the time.
Aww.
So there's little stuff like that. Like, when you think, oh, this social media stuff's a bit long, like little moments like that, actually, like, even if it's just that 0.001% that you are kind of moving the needle. A lot of the people that do follow and engage with me are like from my own community. So just showing that, actually normalizing the idea of investment, property ownership, the importance of kind of like managing your credit and like financial responsibility.
Yeah.
All the things that like kind of you're doing as well. It's like, it's important and it's good to give back as well.
Oh, I love that. I was going to ask you, when you're acquiring one property a month, is it still through auction?
Yeah, not 100%. I'd probably say I like auctions because it's like, once it's done, it's done. Like, there's no like the seller decides to pull out. There's those sort of change of things last minute. Like, once that hammer drops, you've exchanged. Like, you can legally buy that property. But I'd probably say 50% through auction, like sort of like 25% through open market, and the remaining 25% through maybe deal sources and also just like direct stuff. So people just literally just saying, oh, I've seen you buy properties like this. Are you interested in this house?
Okay, perfect. So we're going to be moving on to the Wealth Woe segment of the podcast. And this is basically where someone submits a dilemma and they just want to get your advice on what they should do.
Okay,
so I'll read. And also, if you guys want to submit yours, the link is in the description box and you can submit it anonymously as well. So this person says, I have purchased a property with my partner last year, a 2-bed flat that we are aiming to rent out in around 3 to 5 years. I have 40K in savings still. Do we work towards purchasing our family home with this money, or do we buy another investment property to rent out now?
So they purchased a property.
So they just bought one
as an investment
2-bed flat. And I think they're living in it because they're saying they're aiming to rent it out in 3 to 5 years. So probably it's too small for them. They still have 40K in their savings. They're asking, should they purchase another investment property now or keep that money and start adding it to purchasing a family home in the future?
Going forward. I mean, one thing I always say, and it does sound like sitting on the fence, but it's very going to be scenario driven. But I would say if they own the property that they're in now and they're living there, I would probably say, and they want to transition to living elsewhere, I'd probably say that I would advise they actually potentially retain the funds they've got now, and use that to add on to. The reason being is because if they end up renting out the property they've got now that they live in, because of the changes in taxation, depending on the tax band they're currently in, because it's in their own name rather than a limited company, let's assume they're, 40% tax rate payer, they're going to be paying higher taxes on that property. They're also not going to be able to claim the interest that they would be able to do if it was in, a limited company. And then beyond that as well, there's the consideration that of stamp duty as well. So if they dispose of an asset plus buy a new family home, it would still class as their own home. So it would save on the stamp duty. So I think whilst, they may want to, they may want to actually buy another investment property now, it really depends on what the value is of the home they want to buy in the long term and where they really want to go.
So but why, let's say for example, but if it was you, would you sit on 40K for another 3 to 5 years?
No, I wouldn't necessarily sit on it. But I think one thing that people often miss out on is the transactional costs. So if their goal is that they know they want to buy this bigger home and they actually need the 40K, if they go and buy an investment property now, right? When they buy that property, they're going to be paying the stamp duty when they purchase. Right now as well, with, interest rates and lenders not being that competitive, you're going to have a lot of high product fees as well. So when you first purchase the property, beyond that, depending on when if they had to sell the property, they would then also have, any early redemption penalties as well, your holding costs, your legal fees from purchasing, your purchasing costs, various other fees. So you'd actually have to work out, although people are like, well, I don't want to just leave that money sitting there. If you know that you're going to need that money in the future, the returns you make in the short term may not outweigh the transactional costs. And that's where maybe they could diversify into different asset classes, whether maybe it's investing in, whether it's investing in stocks and shares, whether it's investing in government bonds, or whether it's maybe actually investing maybe with somebody else. Like you could invest as like an angel investor on another product. But I think because you have to always link not just, I'm just scared to leave this money sitting in the bank, but also make sure that that's aligned to what your long-term goals are. And if you know you're going to need that money to buy your family home, I think there may be a more efficient way to operate specifically for them because of their goals.
Would you recommend any other property strategies, perhaps not like buying like a traditional investment property? Would you recommend any other ones that they could then make better use of that 40K?
I think it depends on, their access to time, expertise, resources. Because for example, whether it's the rent to rent space, they could probably make good returns and even better returns than make from owning property. There's some great options, even in terms of, if they're more have a higher risk tolerance, even strategies like option agreements or options to buy a property subject to planning, using that money to actually purchase. So purchase an option. So maybe you've seen a property that's currently listed as a 4-bedroom house that you think would have potential to turn into 3 or 4 flats. So it goes from being a property that's worth 500K to, as flats, is maybe worth 1.2, 1.3 million. Now you could invest that 40K in the option. So you'd go to the vendor and say look, listen, I want to buy this property, but I want an option to buy it subject to planning. And that option could last for 12 months. During that period, you'd use some of your money for the option, but also for the planning, for the professional fees, for the consultancy fees, subject to getting planning. If that option is then assignable, the property was worth 500K day one. Now that it's got planning, it could be worth 600-700K to somebody else. So you could actually sell that option to somebody and they'd then be able to buy the property at that reduced price, but would pay you a premium for your option.
Oh, that's interesting. I didn't know that was a thing. Is that a popular thing?
I guess it's popular maybe for people that are in property. Is that like a form of sourcing? No, it's different to sourcing. So sourcing is very much when you're out there looking for opportunities, in the most common sense, I found this house that's below market value, or I found this house that offers really good yields. I'm maybe not in a position to buy it or don't want to buy it myself for any given reason. I will then sell you this opportunity. And because there's an opportunity to make money, I can charge a premium for it. So that's effectively what sourcing is. Whereas with buying an option, you're actually creating the value by creating an uplift in the value of the asset But then rather than having to go and do all the heavy lifting, i.e. actually do the build or do the renovation, you just sell the opportunity onwards.
Do you know people who do that?
Yeah, like, so I mean, I've done it in the past. I've got stuff that I look at, and sometimes, for example, you can do it fully, like where you do it as an option, or sometimes, for example, you just do it as planning gain. So planning gain is when maybe you buy a house, you get the planning, but then rather than go and do all the hard work of doing the build, you actually sell on just the house with the actual planning, which increases the value. So you can get a margin without maybe having to do so much work, of having to raise funds if you don't currently have the funds to do the build itself as well.
Okay, that's interesting. I think you gave good advice. I think the most important thing that I would say, I'm very like, with the speakers that come onto the podcast, I'm very like, you have to give it tough love. Like, I don't want, but there are some people out there, and they're like, just say as if, usually the people that I bring on are kind of like sometimes like my mentors. I was like, if you were to tell it to me and you were going to tell it to me like real and raw, then just tell me what you would say. So I don't think sitting on 40K for 3 to 5 years is...
No, I definitely think you should utilize
and you were saying
the money,
go put it in other options. So I would say that would be my main thing. I think you have a point. It kind of depends on what you guys' long-term goal is. If they did want to become property investors and do more and more and more, then maybe you do want to open up a limited company and then start adding to your portfolio or whatever. But if you don't, you just kind of want to, I think the house that they have now, they want to turn that into an investment property, and then they maybe just want to have their main source of residency. That's just the
issue. Because the house they've got now is almost definitely owned in their own names.
Yeah.
The long-term sustainability of owning that in your own name rather than a limited company probably isn't worthwhile. So if your goal would be to exit that property into something else to live into, which is why the advice is slightly different. If, for example, they own their own home that they were happy with, and they had just had the 40K, but didn't need the money from their home or elsewhere to transition, I'd say, buying an investment property would probably be what I'd recommend, but it was just based on the specific scenario of that person.
Yeah. Slightly off topic, but on topic. What do you think about people purchasing, young people? I'm talking about young people. Let's say you're coming out of uni, or you're kind of like on your first graduate, let's say between the ages of 23 to 30, purchasing their first property as residential, if they have the choice to not do that and purchase an investment one first. What are your thoughts on that?
I think it's almost like a bit of a red herring, because every property investment, every property purchase is an investment, because you're putting money down for an asset that over time should increase. Like, in the lion's share of scenarios, when you look at things more holistically, they increase over time. And it's about return on investment. So buying an investment property, you're looking at a 25% deposit as a minimum. At the moment, there's 100% mortgages, but let's call it typically 10, anywhere from 5 to 10% as a deposit. Assuming that rates remain the same, assuming prices go up, your return from your money, you're going to see higher relative rates of return on a percentage basis from a capital appreciation standpoint if you've put in less money day one. Because if we take a 100K property, if I've put in 10K and you've put in 25K, if that property now goes up and is worth 150, our return relative on our investment is a lot better. I think one thing that people do need to have is make sure that they understand that because every property purchase is still a type of investment, that it's not just a case of not every home is your forever home, and look at even your residential as sacrifice. You maybe can't just have the property you want with a garden. Maybe you have to get a 1-bed rather than a 2-bed. Maybe the location isn't exactly what you desire, but also focus on properties that are going to work and tick both boxes at an earlier stage.
So your opinion is that
I would, for the first purchase, I would say depending on your resources, I would say that buying a residential property does still make sense.
But the thing is with that, the argument of like, let's say it's 100K, is that when you're buying an investment property, you're not necessarily going to buy it in the same place that you would buy when you're buying an investment, you're not necessarily going to buy it in the same place that you'd buy a residential. So you could do 30K. Let's say you're going to buy somewhere to live in London. Maybe you put down 30K for a 300K property. Whereas up north, you could put down that same 30K and then get a HMO.
Yeah, there and thereabouts. And I think it's about what do you want and looking at where yield versus capital appreciation and what your target is. Because let's say the person who's 23 to 30, they're in a position where all things going well, they should see quite an exponential growth in their income. So in terms of what that property in the north is going to give them, the focus is around yield in terms of that's where your real focus is going to be. And that's why you're buying a HMO or you're buying a property that yields quite well. But the money that you're going to make in terms of the extra £200-300 that you're going to make is probably going to be dwarfed by your increase in salary over that time. Whereas the capital appreciation that you would make ideally in London should outstrip that.
If you're able to take advantage of that.
What do you mean, sorry?
Because like, let's say, for example, you buy something up north that's an investment, right? In 5 years' time, you can easily remortgage. Maybe you might not see as much capital appreciation as you would see in London, but you have more of an incentive to take that money out and then use it again. If you're living in a residential, most people are not in 5 years going to take out equity from their home and then use it to do something else.
And I think that's where the crossover is, because I always did and always would have. Because my
even
salary,
on your main home?
Yeah, because in my mind, because it's just an asset, I have no intention, I guess, over time to really pay off my home. It's not something that I'm like, right, I want to pay off my home.
That's a huge difference, because when people buy residential, they always are, people even say like overpay on your mortgage, right? They want to pay it down as much as possible.
And I understand the logic behind it, but it's like, I always look at it on a basis of, look, if I've got one home for 500,000 that's, fully paid off for argument's sake, then obviously I don't have the monthly mortgage cost that the other person would have of maybe £2,000 a month. But then if rather than having that one home fully paid off, you now own 4 or 5 homes and the investment properties are at a 25% loan to value. So you've got a 75% mortgage. If each of those properties positively cash flow you, say £800 a month, you're still in a better cash position, regardless of the fact that, yes, you still have debt on your own home, but on a monthly cash flow basis, you're in a better cash flow position. The honest thing is also you need to consider that you've got more exposure to risk. There's more boilers that can break down. There's more tenants that could not pay. But at the same time, you then also collectively are, rather than controlling £500,000 worth of assets, you're controlling £2.5 million. So if the capital appreciation continues, a price spike of 10% rather than making you 50,000 makes you 250,000.
Perfect. All right. So we're going to be moving on to the quick fire money questions. 3 questions that we ask every guest, and you just say whatever comes to your mind. So the first one is, what is the best investment you've ever made?
Angel investing into a production company.
Ooh, a production company.
Yeah. If you ask me what that means, I'll have to be honest. I don't really understand. I just know that it is a friend's business.
Yeah.
I know that it's made me my best ROI from any investment.
But have you exited?
No.
So are you just an equity owner in the business and you get a payout?
Yeah.
Is your ownership share significant, or is it small and they've just done really well?
Significant.
Okay.
But it was the time, like it was a friend that said, look, I need this money. I'll give you this. I didn't really understand it. I was like, all right, sounds good.
Okay. Second question is, what is the biggest money mistake you've ever made?
From a biggest money mistake is just not paying attention to the little things. So like letting a flipping £40 Thames water bill go when I sell a property and not closing the account properly, that having an impact on credits. It's an unpaid bill that probably costing £20,000 to £30,000 in terms of the cost implication that had on going to get a buy to let on another property with a less preferential rate.
The little things. Okay. And then what is one piece of advice you'd give to someone who is trying to build wealth or build wealth globally?
Don't get distracted by like shiny penny syndrome in that you have to do everything all at once, all of the time. Focus on specialization. Do one thing really well, become an expert in that. And over time, you'll naturally find whether it's different businesses or different opportunities for you to invest in off the back of the fact that you've built realistically the best asset class, which is cash being the most liquid to now allow you to diversify.
That's good. And you have a business in Dubai, right?
Yeah.
Was that intentional, diversifying?
No.
Mm-mm.
It was just from enjoying going to Dubai.
Mm.
And I said, I'm not going to keep paying to come here. I need to be paid to come here.
Mm.
And just a friend had like a friend sort of kind of just as you do, you talk about like sort of stress points within a business, what he was struggling with, and just sort of kind of saw that, we could provide a service there. And I've been running that for like the last 4 years, very hands off. But it works. It pays the bills and allows me to sort of enjoy when I'm in Dubai.
Pays the Dubai bills.
Exactly, quite carefree.
You see, how much of the work that you do now is partnership with like, I'm not talking about like you have a VA or whatever, but you're partnering with other people in terms of the actual business?
A lot less than it should be. Like I should do a lot more partnerships and joint ventures. But as we spoke about off camera, I don't always like people. And the idea of like being incumbent to other people and having to be like, oh yeah, this is what we're doing here. This is why we're doing it. And I guess probably from not having the best experiences in, businesses that have multiple founders, I don't do enough of it, but I have made an active commitment to do more JVs because, real wealth a lot of the time comes from collaboration.
Yeah, I think that's one of the things that I have been learning and seeing from some of the guests that have made stupid money. A lot of the things that make them that money is not, they don't do it by themselves. Like they build their expertise. Like we had this one guy called Max Maxwell. He's sick. Like he has like a 45, probably more, but like a 45 million development in Zanzibar that he fully funded himself. But a lot of how he made money, he did real estate wholesaling, which is sounds similar to the things you were talking about with options, but not quite. And he learned that skill with real estate wholesaling, and then just did a bunch of different JVs and was investing in a bunch of different businesses. And he is like making so much money. There's a lot of value.
I look at loads of things, and if I did a lot of things, I could have made like, ridiculous amounts of a lot more money. But I probably, in hindsight, I'm still glad that I didn't, because I probably wouldn't have been happier. Like, because there would have been a lot of stress that came to it. There would have been, a lot of things that I couldn't have done. So life is, I think like money's amazing. It's a facilitator, but it is that. And you can't get too caught up in just that I need to make money, because there is always going to be somebody with more money. There is always going to be somebody, regardless of how much you make, with a bigger yacht, with a nicer jet, whatever the case may be. So you can't base success just on how much money you've got. It's just got to be on what that money allows you to do and how happy that makes you.
I like that. I think we can end the podcast there. Lots of good stuff. It's probably the longest podcast that I've done. But where can they find you? So what if they wanted to learn more or whatever, where would they find you?
So Instagram, PropertybyKazy, Kazy. YouTube's the same, hundreds of hours of just free content. So you don't have to pay for anything. Just go and check it all out. If you want to work with me closer, the pbkcommunity.com. You can watch some videos, see if you think it's for you and have an opportunity to join.
Thank you.
Thank you.